Imagine logging into your brokerage account. The market is just violently swinging. Inflation is basically dominating every single headline. And the global supply chain seems, well, completely broken.
Yeah, absolute chaos.
Right. And over the course of 3 wildly volatile, totally unpredictable years, you just sit there and watch a public portfolio grow from roughly 1.2 million to $3.3 million.
Oh, wow.
I mean, that is an absolute mountain of capital created during a time when, most retail investors were literally just trying to keep their heads above water.
It really is. I mean, it forces you to rethink what actually drives market returns.
Yeah.
We are talking about a period defined by macroeconomic panic. Institutional money was retreating, right?
Yeah, totally running for the hills.
Yeah, like hiding in short-term treasuries and massive mega-cap tech stocks. And yet, the portfolio backing the thesis we're examining today nearly tripled just by, ignoring the noise and looking at entirely different consumer metrics.
Or, as the creator of this thesis colorfully puts it, this was a period where millions of flapjacks were made.
I love that.
I absolutely love that phrasing, too. Flapjacks, just stacking them up to the ceiling. But, I mean, you and I are not here today just to marvel at somebody else's flapjacks. We're looking for the actual recipe.
We definitely are.
So today's deep dive unpacks a massive, really comprehensive thesis from the YouTube channel Financial Education. We are looking at what is essentially a masterclass in contrarian retail investing, covering 10, well, technically 11 specific stock picks that are all currently trading under $100 a share.
But, the ticker symbols are arguably the least important part of this entire framework.
Right.
Because anyone can throw a dart at a list of stocks. What makes this particular framework so fascinating to study is the underlying architecture. We're looking at a highly specific, fundamentally contrarian view of the American consumer over the next decade.
And it completely rejects the headline data, doesn't it?
Totally. It completely rejects what you see on traditional financial networks and instead looks at the raw, ground-level reality of how money actually flows through a household.
Okay, let's unpack this. Because the foundation of this entire thesis starts with the consumer. And I want you, the listener, to really imagine how these massive market forces apply to your own daily spending, your own budget, your own household.
Yeah, make it personal.
Exactly. Before we jump into the mechanics of individual companies, we have to establish the economic soil. Like, why is this thesis so incredibly bullish on consumer-facing stocks right now at a time when, consumer sentiment surveys are seemingly in the gutter?
Well, to understand the bullishness, you have to look at the single largest line item on the average American's balance sheet, which is housing, specifically rent and mortgages.
Right, the massive chunk of the paycheck.
Yeah. The core argument here is that consumer companies, the businesses selling cosmetics, energy drinks, athletic wear, they only truly thrive when the cost of shelter is stagnant. If you look back at the period between 2010 and 2019, we saw a golden age for consumer discretionary stocks. Coming out of the great financial crisis, housing was a toxic asset, home prices were depressed, and institutional capital wasn't yet, cornering the single-family rental market.
So rent was largely manageable and, more importantly, predictable.
Exactly. The denominator of living expenses was fixed. If you got a raise at work, or if a dual-income household pulled in a bonus, that capital didn't immediately get absorbed by a landlord.
It flowed directly into the broader economy.
Right. That discretionary income swelled, and consumer brands rode this massive decade-long wave of margin expansion. People had a sheer liquidity to upgrade their lifestyle buying premium lattes, high-end skincare, branded apparel.
But then 2021 changed the fundamental math of the American household. Rents just ballooned at a historic rate. We saw the median home price skyrocket from roughly $320,000 to over $440,000 at the peak.
And the consumer immediately suffocated.
Yeah. I look at the charts for some of these consumer stocks, and they didn't just correct, they were entirely decimated. We're talking about companies dropping 50 to 80% from their all-time highs.
Yeah, it was brutal.
The market priced in a total collapse of discretionary spending because the rent crisis basically ate the middle class.
Which brings us to the current inflection point, and honestly, the most controversial part of this thesis. The official macroeconomic data, the Consumer Price Index numbers released by the Bureau of Labor Statistics, currently states that rent is up 2.9% year over year.
Right, the official narrative.
Yeah, but the creator of this framework calls complete BS on that number. The argument is that official government data relies on notoriously lagging survey metrics. If you ignore the headline data and look at the actual reality on the ground, The housing cycle isn't just cooling effective rents or actively dropping.
Okay, I have to push back here. Let's say I accept the premise that government rent data is lagging. Inflation has still heavily impacted the entire basket of goods. I mean, even if rent magically flatlines tomorrow, the cost of groceries is still vastly elevated from 2019. Car insurance premiums are spiking nationwide. Energy costs fluctuate wildly.
That's true.
So I'm struggling to see how a mere flattening of rent suddenly saves the consumer when literally everything else is still historically expensive.
It's a great point, but it comes down to absolute dollar allocation versus percentage increases. Yes, groceries are more expensive. A dozen eggs or a pound of beef hurts more at the checkout line. But your grocery bill is a fraction of your housing cost.
Okay, I see where you're going.
If your rent is $2,500 a month, a 10% increase is an extra $3,000 a year, stripped from your after-tax income. That is catastrophic. If your grocery bill goes up 10%, it is painful, sure, but it doesn't fundamentally break your ability to service debt or, like, occasionally buy a luxury item.
Think of it like a breathing room budget. Imagine your discretionary income as the oxygen in a locked room.
That's a good way to put it.
When a massive immovable object like rent starts expanding, it physically displaces the oxygen. You are suffocating. You are making hard, defensive choices just to survive the month. But if that massive object stops growing, or better yet, slightly shrinks, you instantly get that breathing room back.
Exactly.
It doesn't matter if the smaller objects in the room, like groceries, are still taking up space. The sheer volume of relief from housing costs lets you take a deep breath and start spending on premium goods again.
And the mechanism driving that shrinkage right now is landlord concessions. This is where the official data completely misses the boat. Apartment complexes across the country are facing massive new supply coming online.
Oh, right. All those buildings that started construction during the boom.
Yeah, exactly.
Right.
To maintain occupancy rates without officially lowering their sticker prices, they are offering 1, 2, or even 3 months of free rent on 12 to 15-month leases. If you sign a lease for $2,000 a month but you get 2 months free, your effective rent just dropped to roughly $1,700 a month. That is hundreds of dollars suddenly injected back into the consumer's monthly cash flow. Combine that with median home prices cooling back down toward the $400,000 range, and you have a massive macro tailwind quietly building.
So the soil is fertile again, the oxygen is returning, and that sets up the aggressive move into consumer equities that are sitting at, decade-low valuations.
Precisely.
The thesis attacks this renewed discretionary income, starting with the beauty industry, using a very distinct barbell strategy. We are looking at capturing both ends of the consumer spectrum with Estee Lauder and ELF Beauty.
Let's analyze the high end of the barbell first. Estee Lauder, ticker symbol EL, trading around $68. This is the ultimate aspirational spend.
Right.
The underlying logic here is about floor space monopoly. If you walk through a high-end retailer like Nordstrom and survey the premium makeup counters, Estee Lauder effectively controls a staggering percentage of that real estate through its portfolio of seemingly independent luxury brands.
So they basically own the perimeter of the department store. When that rent pressure comes off and a consumer suddenly feels a flash of wealth, that is where the capital goes.
Yep.
And the thesis targets here are incredibly aggressive, based on a forward PE of roughly 25. We are looking at a bear case of $100, a base case of $155, and a bull case pushing past $200. I find it fascinating that even the absolute worst-case scenario models, like a 40% upside from current levels.
Yeah, that aggressive target implies that the market is fundamentally mispriced the margin recovery of luxury cosmetics. But the other side of this barbell is arguably much more intriguing from a unit economics perspective.
Oh, absolutely.
We're talking about ELF Beauty, ticker ELF, currently trading at $60. We're looking at a $3.7 billion market cap that operates on an entirely different philosophy, which is prestige quality at mass market drugstore pricing.
Here's where it gets really interesting. The forward PE on ELF is currently hovering around 18. I look at that number and I see a massive disconnect. We are talking about a company projecting double-digit top and bottom line growth extending deep into the 2030s. I have to ask you, why would Wall Street assign a multiple of 18 to a company with that kind of terminal growth velocity? That is pricing them like a mature, stagnant utility company, not a beauty disruptor.
Well, Wall Street is punishing them for macroeconomic optics. When algorithmic trading models see the tag consumer discretionary, they automatically discount the multiple, assuming any economic tightening will just destroy demand.
Sure, algorithms aren't nuanced.
Exactly. But ELF actually operates as an economic chameleon. In a booming economy, their absolute volume skyrockets. In a tightening economy, they capture what we call the trade-down effect.
Yeah.
Consumers who can no longer afford a $45 luxury foundation will trade down to ELS $14 alternative because the formulation quality is remarkably similar. They act as a defensive hedge wrapped in a growth stock.
And the growth isn't just organic, right? It's highly acquisitive. They recently integrated Naturium, a very successful clinical skincare brand, and they acquired Road Beauty, which brings the massive cultural gravity of Hailey Bieber's audience.
Huge move.
They are aggressively pushing these across U.S. retail channels and expanding internationally.
But here is where we really have to debate the capital allocation strategy. The thesis points out that ELF's net margins are expected to explode over the next 12 to 24 months precisely because they are pausing their acquisition spree.
Okay, why?
They have to digest Naturium and Road Beauty. Because they aren't deploying capital for new buyouts, the cash is going to pile up on the balance sheet, setting the stage for massive stock buybacks.
Okay, I'm incredibly skeptical of that being a bullish signal. Yeah. If a high-growth beauty disruptor suddenly stops acquiring and just starts hoarding cash to buy back its own stock, doesn't that signal to the market that their internal innovation engine has stalled? I mean, Wall Street usually punishes growth companies that suddenly start acting like legacy value traps, trying to engineer their earnings per share through financial gymnastics.
That is a fair criticism if the company has saturated its total addressable market. But ELF is nowhere near saturation, particularly in international markets and their newly acquired skincare verticals.
So it's not a white flag.
No, not at all. The buyback isn't financial engineering to mask stagnant growth. It is an opportunistic strike against a mispriced float. If management knows their forward growth rate is 15 to 20% and the market is pricing them at an 18 PE, buying back stock is mathematically the highest return on invested capital available to them.
That makes sense.
It aggressively shrinks the denominator of shares outstanding, right as the numerator of net income is accelerating.
Which explains why the recent drop to $49 a share was categorized in this framework as silly pricing. The targets reflect a severe market correction. A bear case floor of $60, assuming growth absolutely cratered, a base of $140, and a bull case returning to previous highs over $200.
Yeah, the barbell strategy makes perfect sense here. Estee Lauder captures the luxury margin expansion, and ELF captures the defensive volume and share buyback acceleration.
But what happens if the foundational rent thesis is entirely wrong? I mean, what if inflation remains sticky and that breathing room never actually materializes for the consumer?
Then you need a backup plan.
Right. This framework anticipates that risk by moving out of pure discretionary growth and into extreme defensive inelasticity. We pivot from cosmetics into scented soaps and absolute household necessities, specifically Bath & Body Works and The Honest Company.
This is where we test the stickiness of consumer habits. Let's look at Bath & Body Works, ticker symbol BBWI, currently trading at $18. This is a business with a market cap north of $3 billion. But it is currently trading at a staggering forward PE of under 7.
A multiple under 7 implies the market believes this business is in terminal decline. Like, it implies the cash flows are going to permanently evaporate.
It is the definition of peak institutional pessimism. And while you wait for the market to realize that people haven't stopped buying soap, you are collecting a very well-protected 4.3% dividend yield. The payout ratio is incredibly low, meaning that even if revenues contract slightly, the dividend is totally safe.
Wow.
But the real argument for Bath & Body Works isn't purely financial, it is behavioral.
And this introduces one of my favorite anecdotes from the source material.
Oh, I know the one.
The creator of this framework openly admits to his audience that he obsessively visits Bath & Body Works. He talks about getting in touch with his feminine side, buying the pumpkin-scented soaps in October and hunting down the candy cane scents in December. He actually tells his viewers, "Don't judge me."
It's hilarious.
It's funny, but it reveals something profound about unit economics.
It really does. It reveals the power of an emotional moat. A consumer doesn't buy a $9 pumpkin soap from Bath & Body Works because it is the most efficient chemical compound to remove dirt from their hands.
Definitely not.
They buy it for the psychological dopamine hit. It is seasonal nostalgia bottled up and sold at a 70% gross margin.
It perfectly ties back into the budget psychology we discussed. Even if your budget is completely redlined, you might cancel a $2,000 vacation, but you will still spend $9 on a seasonal candle to make your apartment feel festive. It is an affordable luxury that acts as a psychological coping mechanism. That revenue base is incredibly sticky, which is why the targets here are a bear case of $25, a base of $32, and a bull of $40 plus.
But if you want to look at a revenue base that is entirely immune to consumer psychology, you look at the other half of this defensive strategy. The Honest Company, ticker HNST, currently trading at just $2.75 a share.
Okay, this valuation deeply confuses me. We are talking about an entire publicly traded company valued at roughly $300 million. I mean, I can walk into almost any Target or major grocery chain in the country and see their products dominating the end caps.
Yeah, the market is fundamentally mispricing the balance sheet risk.
Yeah.
The Honest Company has zero debt.
Zero.
Zero. They're sitting on a massive pile of cash, and they are crossing the threshold into sustained profitability. And crucially, look at the product mix. We're talking diapers, baby wipes, clean household sanitizers.
All right, you can decide not to buy the pumpkin soap if you lose your job. You cannot decide to stop buying diapers. The demand curve is entirely inelastic.
Which makes the $300 million valuation an extreme market inefficiency. Wall Street algorithms are grouping Honest Company into the unprofitable microcap consumer brand bucket, treating it with the exact same risk profile as, like, a speculative direct-to-consumer mattress company that might file for bankruptcy next week.
That's crazy.
They are completely ignoring the fortress balance sheet and the absolute necessity of the product. The downside risk is mathematically capped by the cash on hand.
Which explains the asymmetric targets. I mean, for a stock trading under $3, the worst-case bear scenario is modeled at $5, which is nearly 100% return even if everything goes wrong. The base case is $10 and the bull is $15 plus. It is a textbook example of macro fears arbitrarily punishing a micro balance sheet.
Yeah, they're grouped with Fubo as a 2-for-1 pick in the source material, which we'll get to later, but the value proposition here is just wildly skewed.
Right. So we've explored how the consumer defends their budget with necessities, but let's look at how their evolving tastes are actively destroying legacy industries. We transition from household goods into the logistics and distribution of what we eat and drink, the food and beverage disruptors, Celsius and Cheesecake Factory.
The energy drink sector is a phenomenal case study in duopoly disruption. Let's look at Celsius, ticker symbol CELH, trading at $34. For decades, this space was entirely controlled by Monster and Red Bull.
Yeah, they were untouchable.
Totally. But Celsius broke that dominance by attacking the fitness and clean energy demographic, and they are currently trading at a forward PE of 20.
I would argue a 20 multiple is shockingly cheap for a company generating double-digit growth regardless of the interest rate environment. I mean, caffeine addiction is completely agnostic to the Federal Reserve.
Very true.
But Celsius is no longer just a single product growth story. They own the Alani brand, which is dominating the female demographic, and they recently acquired Rockstar Energy from Pepsi.
And honestly, the Pepsi dynamic is the entire fulcrum of this investment thesis. Pepsi is not just a strategic partner. They are a massive equity holder and the primary global distributor for Celsius.
Let's drill down into the mechanics of that. Why does piggybacking on Pepsi's trucks fundamentally change the valuation of Celsius?
Because it completely alters the margin profile. Building a direct store delivery, or DSD, network is the single most capital-intensive barrier to entry in the beverage industry.
Because you need physical assets, right?
Exactly. You need fleets of refrigerated trucks, regional warehouses, and thousands of unionized drivers just to get your cans onto the physical shelves of a gas station in rural Ohio. Monster Energy achieved global scale by partnering with Coca-Cola's DSD network. Celsius is running the exact same playbook with PepsiCo.
So all the heavy lifting of infrastructure capital expenditure is already done. Celsius just has to manufacture the syrup and let Pepsi push the product through a pre-existing globally optimized logistical pipe.
Precisely. The gross and net margins are mathematically forced to expand over the next 36 months because the operational leverage is staggering. When you plug a rapidly growing brand like Celsius and a legacy revival project like Rockstar into a distribution machine that touches every convenience store on Earth, the revenue velocity detaches from the underlying capital costs.
The targets reflect that logistical hyperscaling too. Bear $45, base $75, and a bull of $100 plus. And it is fascinating how modern retail investors intertwine this kind of dense logistical analysis with their personal lives.
Oh, absolutely.
In the original source material, right, while dissecting the Pepsi DSD network, the creator casually mentions he is moving into a newly finished house next month. He's looking at stock charts with literal construction photos in the background.
Yeah, I noticed that.
It shatters the illusion of the Wall Street suit. He is building out a 3-year financial thesis, specifically to fund the physical architecture of his life.
It grounds the entire exercise. Capital allocation isn't just an abstract academic theory for these guys. It is the mechanism for securing generational stability.
And speaking of physical architecture and real estate, that brings us to a company that I believe is universally misunderstood by retail investors, the Cheesecake Factory. Ticker cake, trading at $56. When the average person hears Cheesecake Factory, they picture a massive, spiraling menu, giant portion sizes, and a legacy suburban mall restaurant.
Which is exactly why it trades at a deeply discounted forward PE of 13. The market views it as a mature, slow-growth dinosaur. But the true underlying value of this equity has very little to do with cheesecake.
Right.
The structural alpha lies in their acquisition of a portfolio of restaurant concepts from a developer named Sam Fox.
This structural dynamic completely changed my view of the company. It operates less like a restaurant and much more like a tech incubator in Silicon Valley.
That's a great analogy.
Think of Sam Fox as the brilliant startup founder. His unique talent is ideation, creating an incredible menu, a great vibe, a highly profitable local dining concept. But as any restaurant owner knows, the friction of scaling from 3 locations to 300 is fatal.
Oh, it destroys most restaurants.
Exactly. You have to deal with commercial real estate negotiations, global supply chains, massive HR infrastructure, and payroll logistics.
So Cheesecake Factory effectively buys the intellectual property of the restaurant concept and applies its massive, optimized corporate infrastructure to scale it. They are the execution engine for Sam Fox's ideation. And the 2 primary concepts they are aggressively rolling out right now are incredibly potent.
The first is North Italia. The thesis explicitly positions this as the ultimate Olive Garden killer. The argument is that the millennial and Gen Z consumer has fundamentally outgrown Olive Garden. They perceive the food quality as stagnant.
Yeah, it's seen as a bit dated.
Right. North Italia is engineered to feel like an authentic, high-quality, local, mom-and-pop Italian joint. But it is backed by the supply chain efficiency of a billion-dollar conglomerate.
I would argue that legacy brands like Olive Garden have massive defensive moats built on prime real estate and deeply entrenched middle American habits. Are they truly terrified of a concept like North Italia?
They absolutely should be. Look at the unit economics. When you combine perceived authenticity with higher ingredient quality, you unlock massive pricing power. A consumer will gladly pay a 15% premium for a pasta dish if the aesthetic of the restaurant makes it feel like an experience rather than just a fast casual transaction.
That's very true.
The second concept in this incubator is Flower Child, which takes the rapid customization model of a Chipotle fast, healthy, high protein, but elevates it into a sit-down, premium environment.
It is an incredibly efficient use of capital. Instead of paying corporate consultants millions to invent a new restaurant brand in a boardroom, you acquire a concept that is already generating massive revenue per square foot in a test market, and you use your balance sheet to copy and paste it across the country.
And while Wall Street waits to realize that cake is a scaling engine rather than just a legacy diner, investors collect a very reliable quarterly dividend. The targets here are a bear case of $50, a base of $80, and a bull of $100 plus.
It's a really solid setup.
Definitely. So we have spent the last half hour detailing how this younger, digitally native consumer is fundamentally rewiring the way they eat, drink, and maintain their households. But if their consumption habits are changing, their capital management habits are changing even faster.
Oh, without a doubt.
The legacy banking model, marble floors, tellers, hidden overdraft fees, is just as vulnerable as the legacy restaurant model. We have to look at the financial ecosystems of the future. Let's analyze SoFi Technologies and Robinhood.
Let's tear down the banking model with SoFi, ticker SOFI, currently trading around $16. The ambition here is staggering. The stated goal is to become a top 15 global financial institution within the next decade, led by CEO Anthony Noto, who's basically in the prime of his career.
I look at SoFi and I see a company trying to bridge 2 totally different valuation models. They want the high multiple valuation of a nimble tech platform, but they have the regulatory burden and loan book risk of a traditional bank.
It's a tough tightrope to walk.
How do they actually achieve that top 15 status without taking on catastrophic credit risk?
By heavily pivoting toward an asset-light model. Traditional banks make money by taking your deposits and lending them out for mortgages and commercial real estate, absorbing all the default risk.
Right.
SoFi is increasingly focusing on a technology and fee-based architecture. But the true engine of their valuation relies on a specific metric. If we connect this to the bigger picture, the entire fintech war is being fought over customer lifetime value, or CLV.
Break down the math of that CLV model. Why is a 22-year-old opening a free checking account worth so much to SoFi?
It is about lowering customer acquisition cost across multiple financial verticals. If a traditional bank wants to sell a mortgage, they have to spend thousands of dollars in marketing to acquire that specific lead. SoFi bypasses that entirely.
Because they already have them in the ecosystem.
Exactly. They spend a tiny amount of money to acquire a 22-year-old college graduate by offering a sleek app, a high-yield savings account, and zero fees. They accept that this customer isn't highly profitable today, but they own the primary financial relationship.
Wow, okay.
When that 22-year-old turns 28 and needs an auto loan, they don't shop around. They just click a button in the SoFi app. When they turn 33 and buy a house, SoFi originates the mortgage. When they turn 40, SoFi is managing their six-figure investment portfolio.
It is the creation of a closed-loop wealth garden. You capture the demographic when their net worth is essentially zero, and you monetize their entire financial life cycle as their income scales over 20 years.
Yes, exactly.
The targets reflect that long-term compounding, too. Bear $15, which prices in a severe macroeconomic recession, crippling their loan book base $35, and bull $50 plus.
But then we pivot to the other dominant fintech player, and the thesis issues a massive flashing red warning light.
Robinhood.
Robinhood, ticker HOOD, trading at $68 with a market cap pushing past $50 billion. The short-term mechanics of Robinhood's revenue are heavily driven by crypto asset volatility.
Very heavily.
The creator of this framework explicitly warns that if Bitcoin suffers a severe drawdown, say, dropping into the $30,000 range, Robinhood's trading volume will completely evaporate. The stock could violently compress to the $35 to $45 range in a matter of months.
I have to challenge the long-term viability of this platform. Is Robinhood actually a real financial institution, or is it just a heavily gamified casino acting as a proxy for Bitcoin volatility?
It's a valid question.
I mean, if your revenue model requires retail investors to constantly churn speculative assets, that is not a durable banking ecosystem. That is an entertainment company relying on market mania.
That is exactly the narrative the current CEO is desperately trying to rewrite right now.
Yeah.
Yes, the legacy revenue was built on payment for order flow and zero-to-at option speculation. But look at where they are aggressively deploying capital today.
Where are they going?
They are launching massive prediction markets, which is a highly lucrative, rapidly expanding vertical. They are rolling out a deeply integrated credit card ecosystem. They are offering aggressive matches on IRA transfers to steal sticky retirement assets away from legacy brokers like Fidelity and Schwab.
Oh, right. They are trying to use the casino profits to build a legitimate bank. If they can survive the inevitable drawdowns in crypto volume and successfully transition those speculative day traders into long-term retirement planners, the upside is massive. The targets reflect that binary outcome. Bear $60, base $120, and a bull of $150 plus. So we have charted the course from consumer necessities to fintech disruption. But to conclude this analysis, we have to wade into the most psychologically difficult sector of the market.
The contrarian bets.
We are looking at the hated outliers companies that Wall Street currently utterly despises or fundamentally misunderstands. This is where contrarian investing moves from a theoretical exercise to an emotional gauntlet. Let's start with the one that genuinely shocked me, which is Nike. Ticker NKE, trading around $42.
The valuation disconnect here is jarring. Nike's market cap has bled out to roughly $50 billion. To put that in perspective, the global multi-generational athletic dominance of Nike is currently valued roughly the same as Robinhood.
So what does this all mean? Why is Wall Street punishing the swoosh with such historical severity? You don't lose tens of billions in market cap just because of a couple of bad quarters.
Well, Wall Street is punishing them because Nike's supply chain suffered a catastrophic bullwhip effect. During the post-pandemic boom, consumer demand for physical goods skyrocketed right as global shipping lanes were choked.
Right. Everyone was ordering everything.
Exactly. To avoid empty shelves, Nike over-ordered inventory at peak manufacturing costs. By the time those millions of shoes finally arrived in warehouses, the consumer had already pulled back due to the rent inflation we discussed at the top of the hour.
So they are sitting on mountains of aging inventory that they have to aggressively mark down, which absolutely eviscerates their gross margins.
Yeah.
Plus, they are taking massive restructuring charges as they exit unprofitable business lines and pull back from weakening international markets like China.
It is a fundamentally broken profitability story in the present tense. If you look at their trailing price-to-earnings ratio, which looks backward at the last 12 months of this disaster, it looks expensive, hovering around 28. But the core thesis here relies on forward PE.
Breaks down the mechanics of how management is manipulating those forward expectations.
Nike's executive suite is engaging in a classic kitchen sink quarter strategy. Because the stock has already been punished, management is deliberately issuing incredibly weak, low-ball forecasts for the coming year.
Ah, so they're setting the bar on the floor.
Exactly. They are writing off all the bad inventory now, taking all the financial pain up front, and intentionally lowering Wall Street's expectations to a hurdle they can easily clear.
They are completely clearing the runway. The creator of this thesis argues that this exact moment represents the absolute bottom of Nike's profitability for the next decade.
He does.
If you look past the manufactured short-term pain, the true forward PE is likely closer to 19 or 22. And if you project the normalized margins out 24 months, you are buying global dominance at a PE of 10. The targets require massive conviction. Bear $60, base $120, and bull $180 plus.
But stepping in to buy, when every single analyst is issuing a downgrade, requires an iron stomach. The framework points out that institutional consensus is frequently spectacularly wrong at the exact bottom of a market cycle.
Yeah.
Look at the historical data. Wall Street universally declared Meta dead when it crashed to $88 in 2022.
I remember that vividly.
They completely abandoned Shopify at $25. They laughed at Palantir at $5.98.
The analysts are human, you know. They suffer from recency bias. They look at a turnaround year, see the massive margin compression, and extrapolate that short-term pain into a permanent terminal decline. They entirely miss the forest for the trees.
They really do.
And that exact psychology might be driving the second half of this contrarian play, which is Fubo TV, ticker FUBO, trading at $12. As we mentioned earlier with Honest, this is the other half of that pick. The entire enterprise is valued at just $1 billion. The thesis points to massive upside in sports streaming and their deeply intertwined relationships with Hulu Plus Live TV and Disney. The targets are explosive, bear $12, base $25, and a bull of $100 plus.
But you're a bit skeptical on this.
I have to completely reject the bullishness here. Disney and Hulu have practically infinite capital to burn in the streaming wars. Historically, being a tiny $1 billion player in a multi-trillion-dollar sector dominated by tech monopolies doesn't end in a 10x return. It ends in bankruptcy or a highly discounted fire sale. Why wouldn't Disney just bleed them dry?
Because the antitrust regulatory environment has completely shifted. Disney cannot simply acquire or crush every sports streaming competitor without triggering immediate Department of Justice intervention.
Oh, so they're protected by the DOJ.
Basically, yeah. Fubo has carved out a highly specific, legally protected niche in the live sports bundling ecosystem. The $1 billion valuation implies zero chance of survival, which makes it a highly asymmetric bet on regulatory protection and niche subscriber loyalty.
It is the ultimate high-risk, high-reward binary outcome. And finally, we arrive at the last stock in the framework, which is ServiceNow, ticker NNOW, currently hovering around $100. This is an enterprise software as a service company growing revenues and earnings at a 20% clip, deeply embedded in the internal operations of massive Fortune 500 companies.
And the targets provided for this company are entirely satirical. The creator gives a bear, base, and bull target of exactly $0.
It is a brilliant way to mock the current hysteria gripping Wall Street. The prevailing market narrative right now is a total panic that artificial intelligence is going to instantly vaporize the entire SaaS industry.
It is a profound overreaction.
Yeah.
Will large language models change how software is written? Absolutely.
Yeah, of course.
But the idea that a company growing at 20%, whose architecture is mission critical to how global corporations handle their internal IT workflows and HR logistics, is suddenly going to be replaced by a generic AI chatbot overnight is absurd.
Totally absurd.
Enterprise software is sticky because of compliance, security, and integration, not just raw code. Pricing a dominant SaaS player for zero survival relies on science fiction rather than corporate reality.
It perfectly captures the emotional extreme of the market. And speaking of the emotional side of investing, the creator includes a fascinating detail while wrapping up these highly technical contrarian bets. He talks about sending out actual heavy metal lifetime membership cards to the members of his private financial community.
I saw that.
He also talks about currently grinding through a 60-day ab challenge, actively soliciting his followers to slide into his Instagram DMs with workout advice.
It really reveals the architecture of modern retail investing. In previous decades, financial information was highly sanitized, delivered by men in suits reading off teleprompters. Today, it is deeply parasocial.
Yeah, it's a completely different vibe.
These investors are not just buying a financial thesis, they are buying into a shared lifestyle. They are investing in a community that fundamentally views the world differently than the institutional consensus. That heavy metal card is a physical token of belonging to a tribe that is perfectly willing to buy Nike when Wall Street says it is dead.
Well, we have dissected a massive amount of economic architecture today. We started by challenging the official macroeconomic data, revealing how flatlining, heavily discounted rents are finally injecting discretionary oxygen back into the American household.
Yep.
We followed that liberated cash flow into the highly strategic beauty barbell of Estee Lauder's luxury margins and ELF Beauty's explosive volume. We examined how consumers defend their psychology with Bath & Body Works, and how Honest Company's zero-debt balance sheet protects the ultimate inelastic demand of diapers.
It's a really comprehensive look at the consumer.
We mapped the operational leverage of Celsius riding the Pepsi distribution network, and how Cheesecake Factory uses its real estate mastery to incubate Sam Fox's Olive Garden killers. We broke down the customer lifetime value math driving SoFi's walled garden, and Robinhood's aggressive pivot from a crypto casino into a durable financial ecosystem.
And then into the trenches.
Right. We closed in the absolute trenches of market psychology, dissecting the supply chain bullwhip punishing Nike, the regulatory survival of Fubo, and the AI paranoia entirely mispricing ServiceNow.
But, the true value of dissecting this framework isn't the individual targets, it is the timeline. The foundational philosophy underlying every single metric we discussed is a relentless adherence to a 3-year horizon.
It's 3 years, exactly.
The temporary inventory nightmare at Nike, the potential 6-month crypto drawdown at Robinhood, the short-term margin compression, none of it matters if the fundamental unit economics hold true over 36 months. Institutional Wall Street is obsessed with the next quarter's earnings call. This framework forces you to anticipate where the consumer will be at the end of the decade.
Which leaves me with a final question for you to ponder on your own. This entire financial framework is anchored to the wisdom of a 3-year timeline. You buy the thesis, you endure the volatility, and you wait 36 months for the fundamental value to be realized.
Right.
But we are currently operating in a world where artificial intelligence can render enterprise software obsolete overnight. We live in an ecosystem where a viral 15-second TikTok trend can build a billion-dollar brand in a rint or completely destroy a legacy company's reputation in an afternoon.
Things are moving faster than ever.
So I ask you, is the traditional 3-year buy and hold strategy a reliable anchor to keep you grounded through the daily noise? Or is it a dangerous relic from a slower financial era that simply no longer exists? Think about how radically your own life, your own budget, and your own consumption habits have changed just since 2023. Are you truly prepared to lock your capital into a single conviction for the next 3 years? Thank you so much for joining us on this deep dive. Keep questioning the consensus. Always look for the real math behind the official data, and we will see you next time.